Today I want us to take a look at candlesticks. When you open your trading chart, the first thing that you'll come across are candlesticks. So today we want to delve deeper into candlesticks so that we know the types of candlesticks that are there, and we also know what they represent and how to use them to enter and exit the market. So there are different types of candlesticks that you can find. There are bearish candlesticks. From this, that's where you get your supply zones, where you see price selling or you see the price going down. There are also bullish candlesticks. From this, that's where you see your demand zones, where your price buys or you see your price going up. So when you open your trading chart, you'll see that there are colors that represents these candlesticks. The colors don't matter. You can use whatever colors that you want, but in essence, the candlesticks that are bearish go down. The ones that are bullish, they tend to go up. So what do these candlesticks represent? Candlesticks are there to reveal your market trends. They reveal your market direction. They also define the market structure because they define the price action. During price action, candlesticks form a market trend which can either be bullish, where you get to see that your prices are buying or they are going up. Your price is moving, going upwards. Your price doesn't move upwards in a linear fashion, but it creates higher highs, higher lows, higher highs, higher lows, but consecutively forming an upward trend. And the other market trend that you see is a downtrending market structure. This is defined by a bearish price trend. Action can also move in such a way that it forms a trend that's going down, which is also called a bearish trend. So that's a downtrending market structure as it is seen. Price will move lower high, lower low until it forms the structure. Also, price can move in such a way that it forms a sideways market structure, which is called a ranging or sideways market. This structure forms when candlesticks form a pattern that seems to be bouncing in between two almost parallel lines. These areas are called resistance and support areas. When price action reaches the top zone, it bounces down. When it reaches the bottom area, it bounces up until it breaks this zone. The fourth market structure that can be formed by movement of price is revealed by candlesticks, and it's a noisy market structure or a choppy market. This type of market has no proper direction. It's not easy to decipher the pattern formed by these candlesticks. This market is a market that no one should trade because it represents a higher risk to your equity. So when you see it, you ought to just close your market and wait for a proper structure. So how do you use candlesticks to enter the market and execute your trade? First of all, you need to define your market structure. Is the market trending? If the market is trending, what's the direction of the trend? Is it trending up or is it trending down? If it's not trending, is it ranging or is it a choppy market with no specific direction? In which case, close your trading up and wait for better market conditions. After defining the market structure, look for candlesticks patterns, and if applicable, draw trend lines as well. The candlestick patterns will come on your chart as market chart patterns, the QML pattern, the flag pattern, and also there are candlestick patterns as well. The spinning tops, bottom tops, shooting star, the hammer, the dodges, the engulfing patterns, whether it's bullish engulfing or bearish engulfing. So when you've seen those, you also need to mark the obvious support and resistance zones, where how you note this is you see prices bouncing and turning in order to change the market direction. So these zones can either be horizontal or they can be uptrending or downtrending. And also you need to mark the obvious trend lines, uptrending or downtrending. Mark them on your trading app using the available tools. Also, what you will need to do is for you to look for confluences, for you to mark your entrance points. For example, when price reaches a trend line, is there a defined candlestick pattern in that area? Also, is there a support or a resistance zone at that area? So that when you have about 3 or 4 reasons why you should enter the market, you can better time your trade. Also, Remember, there are psychological factors that will come into play, factors like greed, FOMO, fear, imbalance. And also, you need to look down and see and do a top-down analysis where you look for these factors in your H4 time frame, H1 time frame, and in different time frames so that you spot market structures, you spot chart patterns, candlestick patterns as well. So now, we're going to use candlesticks to be able to see how we can leave our market and close our trade. Candlesticks define trade exit points. When you enter a trade, you'll have to close it. So you close it when market eventually shifts its direction. Markets do not move in a linear fashion. They trend, accumulate, and correct. Thus, a market can have an impulsive rallying movement that goes in one overall direction, and after it reaches a certain point, the market engages in a corrective move as shown in the picture, and it goes in the opposite direction. And also after it reaches a certain area, it goes back again to that impulsive rallying move. Thus, if you enter a trade during an impulsive move, when it ends, you have to leave the market. Candlestick dojis and candlestick patterns will also show you when it's time to leave the market, because candlestick form reversal patterns that define exit points. Do not ignore them, otherwise you'll just give back your profit to the market. The trends also that candlestick form can be used to define entry and exit points. Whilst it's true that one can use a trend line candlestick touch point as an entry point, one can also use a trend line candlestick touch point as an exit point. In essence, when a candlestick touches a trend line, you enter or exit the market. Use this entry or exit point with other confluences as well, and not alone, so that you have at least 3 or 4 reasons why you should enter or exit the market. So how to use candlestick to identify chart patterns so that you can be able to predict price action, because when price moves, candlesticks form patterns that can be used to identify price action and also predict price movements. With time, you'll be better able to identify the patterns that the types of candlesticks form. There are dojis, there are flag patterns, there are QMLs, there are hammers, there are pin bars. There are many patterns that you'll have to know. So you have to look for this, they'll be visible on your chart patterns. For more information about candlestick patterns, I think you should watch my other videos. Otherwise, this will be a very long video. Now that you've learned about candlesticks, got your trading app and try to spot trends and all other market structures. Try and see market direction and where it pauses, where it accumulates, or where it turns. Mark all these areas and see how price behaves in the future when it gets to the zones that you've marked.